You know, part of the purpose of NACD is education. And I have to ask you, how many of y'all remember we were here 4 years ago when we presented the first cybersecurity breakfast meeting? Anybody? Well, it's interesting. I'm listening to cybersecurity certification now. And when we first introduced cybersecurity 4 years ago, everybody's kind of going, what's the big deal? I think Sony had just been hacked. And today, it's at least in the top 5 of every director's meeting when you go, and it's gone from being a cost center for the IT department to where it's now prevalent in all the directors' minds. And what we're trying to do here today is raise the same level of awareness. I don't know if blockchain is going to catch fire like cybersecurity did and become something that's mandatory in the future that you know more about. But again, what we're trying to do here is to raise your level of awareness and education. And in doing so today, we've got a couple of great speakers. I've really enjoyed meeting you guys very much. The bios for Ken Tepper and Frank Mastrangelo are in your packets. Let me just say that these guys are high level, high anxiety, high energy. You're going to enjoy, and they're not from Colorado, so there's a different kind of high, but sorry. I think you're going to really enjoy this level of conversation on blockchain, and it's going to be a little bit different than what you might expect. We always try to find something interesting about our speakers, and I want to give you something that's not in your packet today. Frank, being from Philadelphia, it's a good name, Frank Mastrangelo. That's a good Irish name, right? Had the privilege of working for Walter Annenberg. And one of the interesting things I learned about Frank last night was he was working for Walter when he bought the $140 million Picasso painting called The Jester. And I went home last night and looked it up. And by the way, when Annenberg died, he left his entire art collection, which a decade ago was valued at over $1 billion, to the Metropolitan Museum of New York. So he's got a little interesting twist. You might talk to him after the meeting about that. Ken, on the other hand, all he does, it just seems to work. I mean, this guy, I said, what do you do for fun? And he's sitting here telling me about all these things he's done. And when you read his bio, it's about this long. So you know, he's a very busy guy. He said, well, something interesting about me is, you know, my dad was in the Air Force, so I was stationed in Abilene, Texas. So I have to ask, is anybody here from Abilene first? Okay, good. I said, what did you do for fun in Abilene? And he said, well, when it used to rain, we'd get on our bikes and go right through the mud puddles and watch the water go everywhere. So that's his memory of Abilene. On the serious side, he's an expert marksman, too. 3 points I want you to think about when you take away your thoughts from today's meeting. I think what you're going to hear today is innovation. I think you're going to hear regulation, and I think you're going to hear good governance. And if you think in those terms as you hear about blockchain today, I think these gentlemen up here will give you the necessary skills to ask the questions that you need to be asking going forward as a board. Thank you. Enjoy the meeting.
Good morning. Frank was just saying he likes to walk around a little bit when he speaks, and
I do.
I don't think I'm any different, so we're going to indulge ourselves. It's a great honor to be here this morning. The tremendous list of sponsors is overwhelming, and we're humbled to be able to be here today speaking about an esoteric, complex, and exciting issue. I think you're going to hear things today that may be a little surprising, and we look forward to engaging you in the conversation. I want to really begin reminding us what our focus is. We're board members. The issue really is not what blockchain is, not what Bitcoin is, not what the price of Bitcoin is going to be tomorrow. It's what we should be taking back into the boardroom regarding these things, these opportunities, these challenges, these technologies. What should go back with us to the boardroom, and how do we apply what we've learned in terms of controls and risk management and fiduciary duty in the boardroom. And I'll begin. The late 80s were a time of tremendous drama in this country from a corporate perspective. August 9th, 1989, the Financial Institution Reform, Recovery, and Enforcement Act, FIREA, was passed, and the savings and loan crisis, the cleanup, began. And at about the same time, and that actually brought me to Atlanta. I was recruited by FDIC and became part of the team that helped clean up S&Ls. Something else was going on in Atlanta at the same time. It was the nation's largest, to that point, corporate takeover. RJR Nabisco was in the throes of what was then an unknown phenomena, a hostile takeover. Bids were coming from every place, and corporate boardrooms had become baseball playing fields. CEOs were becoming rock stars. Investment bankers, people were asking for their autographs. And a gentleman named F. Ross Johnson, you may recall, was chairman of RJR Nabisco and CEO. And when the transaction closed and Mr. Johnson walked away, and he passed away recently, a couple years ago. When the transaction closed, Mr. Johnson walked away with about $50-some million. And I guess his next idea for what do you do after that happens is he started an advisory and consulting firm, except clients could only pay him $1. And he was advertising this in Atlanta. And I was a young man. I had just left, getting ready to leave the RTC. So I applied. I wanted to be a client for $1 to F. Ross Johnson in what was called the RJM Group. And to my surprise, I got a response back with a contract in it, in the letter. Sign here, include $1, and you're now a client of RJM. And Mr. Johnson wants to see you Thursday at 11 o'clock. So I went. I brought my $1, and there he was. His assistant, Mary, I'll never forget her, asked me to come back. And I sat down with Mr. Johnson, and he said, young man, for you to get into this room, you've probably got an interesting future ahead. You're probably interested in corporate dynamics, the world of commercial enterprises. I'm going to tell you, I'm going to give you your $1's worth right now. Here's what I'm going to share with you. Don't ever forget this. He said, you may end up a CEO one day. And when you do, this is how I want you to run your board meetings. You're going to go in, and when your board sat down, you're going to do the following. Call the meeting to order. All in favor of the CEO retaining their job for another month, say aye. Any opposed? The motion carries. Let's have dinner. He was dead serious. And it shows how things have changed over time. Now, you might imagine my career wouldn't have gone very far if I had deployed that advice. I tried once, I'll never do that again. So here we are today, and it's not 1989, and we're not RJR Nabisco, and boards don't just have dinner. In fact, it's very much the opposite. Today, our challenges in the boardroom as directors are immense. We know that. The demands on our time are immense. The legal, moral, ethical expectations are immense and sometimes seemingly impossible to comply with. I hate to say it like this, but for those of you that have been in corporate life for a long time, it's a real job now. Because in the past, it was more of a club, it was more of a what's for dinner than anything else. Boards work today. Boards understand the word fiduciary. Boards understand what they do, primarily in terms of their role of monitoring, supervising, engaging, and terminating, when necessary, the CEO. So I'm very respectful of time. I know that as board members, we don't have a lot of it. Whether we're on audit committees or compensation committees or other subcommittees, time is a precious commodity. Many of us who serve on public boards or private boards have other businesses to run, sometimes our own. Time is a very, very important and valuable commodity. So I'm very hesitant to take up any of your time as a corporate board member with anything new or different on an agenda. And I would expect your CEO to be the same. We're going to talk about technology today. We're going to talk about Bitcoin, a cryptocurrency, which in a sense has everything to do with blockchain and nothing at all to do with blockchain. And we're going to talk about blockchain as a fundamental technology that, depending on who you listen to, is going to disrupt and change the world forever or not. I know that Frank and I are going to want you to leave with certain messages and takeaways today. The one that I feel very committed to, that Frank and I feel very committed to, the press talks about blockchain technology and its applications in enterprise as if it is flawless, as if it is a trusted, viable, a tremendous, a world-changing opportunity. It may be all those things, but let me assure you, it is fraught with liability. Bad people, and I'm a banker, I take deposits and make loans. Not everyone who borrows money from a bank is a good person. Bad people exist, have always existed. Fraud exists, has always existed, and always will. Don't think for a moment that just because you label something blockchain, or just because your IT department puts blockchain on the box, don't think for a moment that your obligations to supervise and to evaluate the risk inherent in whatever that application is doesn't exist, because it does. Not only does it exist, it's heightened, because blockchain, from an optics perspective, can actually lull a sense of security that's not there. It comes back to the old adage, garbage in, garbage out. Sure, blockchains, as Frank's going to tell you in a moment, are secure. They're encrypted. They're hard to tamper with. It's a widely distributed ledger. You're going to hear all these things, and they're all true. You're going to hear about how we use blockchain in supply. But here's the bottom line. If a box of fruit is coming into a supply chain on a blockchain, and that box of fruit is rotten, and the clerks who deliver it don't disclose the fact that it's rotten, but that it's saleable, your blockchain is in fact flawed. You are selling rotten fruit. And that blockchain is going to affirm, confirm, protect the fact that that fruit isn't rotten for all of eternity. And God forbid it's something worse than rotten fruit. So you'll get the point. It's an invitation today, and I said this last night, and today, somewhere in the world, today the Bernie Madoff of blockchain is working, is at work. He or she is taking a $300,000 or $400,000 asset and selling it 16 times on a blockchain designed to sell it once. That person's out there. I don't know how it's going to look. None of us do. We don't know when. We don't know where. We don't know the scale. It will happen. It's happened. So don't think for a moment that Bitcoin, cryptocurrencies, are safe and infallible. They're not. Don't think that blockchain technology, as it pertains to your business, as it pertains to your role as board members, is safe. Because it's not. And you're going to have to weigh, each of you on your boards, you're going to have to weigh the role of technology in your company. Is it a core aspect of what we do? Does our P&L rely upon technology to survive and prevail? Or is it just a corollary? Because when you dip your toe into blockchain, you're inviting a whole lot of hurt, whether you know it or not. So let's start out with some definitions. Let's talk about literally what is Bitcoin, what is a cryptocurrency. I will say this when introducing Frank, who among other things is my former boss. I worked for him for 5 years, at which he says he survived, and I say I survived. But you may have heard that Bitcoin, the inventor, is mysterious. Now, I'm already nervous. I don't like things where I don't know who the inventor is, but Satoshi Nakamoto, we know a name, that's all we know. All I was going to point out is I've never seen Frank in the same room as this person, ever. I'm not saying anything more than that. I don't know that that's actually Satoshi Nakamoto. I'm only saying I've never seen them in the same room. Frank, would you give us a little background on what it is we're talking about?
Yeah, sure. So just understanding there's probably varying degrees of understanding as to what blockchain even is. We thought we'd start with a baseline there. I'm sure you've all heard it's a peer-to-peer distributed ledger. So what the heck does that actually mean? Like, what is it in its most fundamental sense? So what it really is this, right? It is a ledger. It is a ledger that you write transactions to. Those transactions are appended, and they cannot be modified. As Ken mentioned, once they're written, they're there forever. So it is a ledger that continues chronologically as records are written. Blockchain, let's break that down. Effectively, there's a record, as we were just describing, a transaction that becomes part of a block, a series of records. That block is chronologically put into a string of blocks, a chain. That's the blockchain. So what does it mean to be distributed? Effectively, there's no central authority or central point like for this ledger. What happens is many peers on the network all have a copy of the ledger all at once. When a transaction is written to any peer, it is synchronized and distributed to all the other peers and written. So effectively, everyone on the network, every peer, has a full copy of the ledger at any moment in time they can validate against. So distributed, peer-to-peer, ledger, right? Effectively a protocol. That's what blockchain is. That's sort of what we're dealing with. We're in the 1972 to 1980 part of the implementation, experimentation, and utilization of that foundational component with blockchain. That at its, I'd say at its the best case, like that's sort of where we are and what we're viewing and what blockchain could become somewhere down the road, right? And that is the underlying foundational component that we utilize for applications and interchange in the future.
Frank, there's a saying, I think, in Texas that goes something like this: if it ain't broke, don't fix it.
Well, so I think that's probably to rephrase that or reposition that. The question might be like, so where is blockchain even useful? Like, why would one use it? There's a couple of scenarios where blockchain really does make sense. In my mind, look, situations where trust is required across parties, like across public networks where it might not exist today, number one. Number two, instances where a distributed rather than centralized ledger really does add value, and I think there are scenarios like that. Number three, I think the most interesting use case that I see right now is providing liquidity into exoteric assets and asset classes that have typically lacked liquidity, even providing access to those assets to individuals that previously wouldn't have had the ability to buy into that asset class.
Part of the strategy, part of the MO of blockchain in many applications seems to be disintermediation, which is a big word, meaning get rid of supervision, get rid of third-party trusted parties, entities that we pay today, typically with a balance sheet, to assure truth, to assure that when someone says I'm selling 7 shares, it is 7 shares of ABC Corp, it is ABC Corp. Blockchain purports to rid us of a great deal of that overview and the cost that goes with it. And I will tell you as corporate directors that when you hear something that sounds too good to be true, it may be, and probably is. My point being, anything or anytime somebody tells me that I should reduce human supervision, reduce the eyes on a transaction because we don't need it anymore, makes me nervous.
There certainly is an anarchist component, let's say, or a group very focused on blockchain, cryptocurrencies, bitcoins, the next ICO, initial coin offering, whatever that might be. At the same time, I think that at least for the mainstream, that's starting to shift, right? And that is initially, the thought was, great, Bitcoin, we're going to replace central banks. Central banks across the world are going to be meaningless. That we will disintermediate fiat currencies. We will be able to transact as we will, completely anonymously, without oversight and regulation and the like. Look, we're in a very, years later now, though, we're in a very different place, right? The SEC's come out with a significant amount of guidance related to initial coin offerings, very clearly declaring them securities, that securities law completely applies to many of these offerings. You're seeing the newest offerings coming through actually, registering, you register with an attestation that you're accredited investors, and they're meeting full guidance either from a private placement standpoint of SEC guidance, or they're going through registration processes with the SEC. That's very different than what the market looked like 3 to 5 years ago, or what the thought process was about how things would evolve.
Let me ask this. When you think about Bitcoin, a cryptocurrency, really the first public application of blockchain technology, how many in the room think that there are vulnerabilities within Bitcoin that make it less than 100% reliable? Or have heard, for instance, the 51% network control, whereas if any pool of miners happens to get 51% control of the network, they can duplicate transactions, which to me, in and of itself, I only need one issue that makes the entire currency really impractical on a scalable basis. I don't need two, that's one. The Chinese market controls arguably over 51% today, right now, of the Bitcoin network, arguably. We know of at least one, if not 2 or 3 instances in the past couple of years where a group of pools have in fact controlled over 51%. We know of at least one instance when millions and millions of dollars of Ethereum were gone, missing one day, because there was a lapse in the code. They fixed it the next day.
I do believe, for what it's worth, I do believe most blockchains that are utilized by corporations in the future, they're going to be private and semi-private blockchains, not large public blockchains or implementations.
So different than
Ethereum or Bitcoin. It's not going to be your company and untold numbers of people you don't know and are unregistered utilizing this infrastructure. Instead, it's going to be York Corporation and your 17 trading partners registering derivatives, registering counterparty risk, registering syndications, things like that across these networks. And by the way, this is some of the ways that blockchain is actually being utilized today. Just in the last couple of weeks, as an example, an Andy Warhol painting, the 14 electric chairs, was actually tokenized, and 35% of it was sold in a syndication to accredited investors. Now think about that for a moment, right? Think about who's had the ability traditionally to buy the Warhol painting was valued at, I think, $5.4 million in total. And as I said, they sold off 35% of it for a little under $2 million in this transaction, tokenized, sold to about 900 accredited investors registering on this platform. Traditionally, who's had access to buy a Warhol painting? right? So while we're still talking accredited investors, there's no question that this is making fine art a very exoteric asset, illiquid to a large extent across the history of time, available to more people. Why is that important? Well, believe it or not, like fine art from a return standpoint has actually outperformed the stock market over the last 5 years, right? As has exotic cars. Right? So there are exoteric, illiquid assets that have actually even outperformed the stock market, even as great as the bull market's been, like over the past 4 or 5 years. These are asset classes that high net worth individuals, other than the highest net worth individuals, have not had access to participate in. Now they do.
So I'm going to presume that in that transaction, the sponsors filed a UCC that indicated their position and the fact that that painting had been sold.
Yeah. So this was a UK
transaction.
UK transaction, not
So
US.
my point would be, whether it be in the UK or here, there's no international cross-border UCC control.
That's correct.
Meaning that, and again, it's not that I'm the naysayer, but everything Frank said is great. The masses can have access to Andy Warhol's electric chairs. I think that's wonderful. The sponsors that sold it, how much did they raise?
It was a little under $2 million.
Raised under $2 million using blockchain. I think that's wonderful.
And the gallery still controls the painting.
Gallery controls the painting. What prevents them from doing the exact same transaction in 4 other jurisdictions around the world who are unaware that it had already been sold? What aspect of blockchain technology prevents that fraud from occurring? And the answer is none.
Exactly right.
So bad people will be bad people. Now, I'm not saying that this transaction was in any way fraudulent. Everyone should have Andy Warhol's 14 electric chairs in their living room. I'm saying that when it gets to your corporate boardroom and somebody wants to sponsor or create a transaction that's blockchain based, don't think for a moment that you're insulated from typical conventional bad guys doing bad things the way they have for all of history and the way they will continue to, because it can happen.
Yeah, I think what you're saying is all the normal aspects of governance, oversight, risk, and due diligence still apply.
Absolutely.
Putting the asset on a blockchain doesn't solve the fact that there are still bad people that will do nefarious things.
Yet when the salespeople come knocking at your door, whether as a director or at the company with management, you're not going to hear a lot of what we're talking about today. They're not even, in some cases, they're not even going to know what do you mean typical governance issues, fraud, controls. They're looking to the future. Blockchain's great, and you're going to get your electric chairs. You got to slow them down. And you got to make sure that your CEO, because after all, at the end of the day, isn't that what we do as board members? We interact and govern our CEO. You got to make sure that our CEOs are realistic in their own understanding and expectations for blockchain. There are examples going back in the past. How many of you have thought about how Linux is deployed in your organizations? How many of you think about, most of you run Oracle databases somewhere in the company. How deep should a director get into IT? I mean, that's a question that's taken on so much velocity and so much importance in the past 10 years. How many of you have technology committees at the board level? Not that you necessarily serve on, but how many of your companies have technology committees? My understanding is that less than 10% of public companies today have technology committees. I suspect that's going to change in the next 10 years, or if not sooner. Maybe blockchain is one of the things that's going to incite that change. As this technology, as Frank talked about some of the opportunities, we want to remind you, very little of it has been scaled. Very little of it has been tested under pressure. And that's when defects, that's when faults often arise. Your company doesn't want to be the first to announce that there is, in fact, some inherent flaw in a blockchain deployment that no one knew about until it reached a certain mass.
Yeah, look, I think one of the most interesting aspects of that is there are really only two implementations that have scaled in any form or fashion, right? And that is the Bitcoin blockchain and the Ethereum blockchain. They're the only two implementations of blockchain that have scaled to a critical mass. Okay, the latency though within Bitcoin, right, makes it virtually unusable for many applications that one originally believed you could utilize it for. Bitcoin is not going to work for micropayments. The latency in the network is just too long. By that, what I mean is I had mentioned to you a transaction gets written to one of the peers, and then that transaction is distributed out to the other peers. That can happen instantaneously in small blockchains,
like it used
and
to.
it can take a really, really long time in large blockchains. And I'll give you a couple examples of this. When Ken and I first started playing with Bitcoin many, many years ago, one of the first things we did was download the Bitcoin Core software. You can download software and create a Bitcoin wallet on your laptop completely anonymously. The first thing that software does is synchronize the Bitcoin blockchain to your machine. Back when we started, that would take a couple of hours, right, to synchronize the entire blockchain to your machine. A year later, that took a couple weeks. A year later, that took a couple months. Today, that's a 250 gig file that you could never actually synchronize. You have to download it from somewhere, fire it up in the software, and then let it synchronize over the course of a pretty long time still. So effectively what's occurred here, what occurs is these blockchains build larger and larger. While we talk about it being decentralized, right, the larger the blockchain gets, the more bandwidth you need, the more storage capacity you need, the more computing power you need, right, to be a peer on the network, meaning the more the network centralizes again. So we can have peers, the larger the blockchain, the more centralized it is. Right, the slower it becomes, the more latency that exists. There are some newer blockchains and newer blockchain technologies that are aiming to solve that, but it's still a fundamental core issue, right, in the blockchains that have been issued today.
Frank, let me ask this. How many of you own Bitcoin, other than Sheldon? How many of you own Bitcoin? How many of you have given serious thought about investing in Bitcoin as an asset class? In your 401k or somewhere else. Yeah. I understand. One of the things that I find fascinating today is you'll read analysts every day, and in fact there was a big price move yesterday, and you'll read the analysts come out and they'll give you their technical analysis, that based on their technical analysis, Bitcoin may in fact get to 5,725 today. It's very possible. And I read that and I think to myself, it must be terrible to be that person. To actually wake up and look at a bunch of lines and charts and have to put in public and sign your name to it that Bitcoin may get to 57. Bitcoin may get to anything. It's supply and demand, period. The only reason it has a value of over a penny is because we've all decided that it should. We trade it as a vehicle because we've decided that we should. We know, everyone in this room knows, what hard asset backs Bitcoin at the end of the day. We know that the answer is nothing but a big electric bill. Even in the tulip craze in Holland, at the end of the day, at least they had a tulip to put in their house.
Well, one more.
Maybe $1 million tulip, but they had a tulip.
Well, one more thing on this topic. Even Ethereum, the Ethereum protocol and blockchain, it was developed to try and solve some of these latency issues. As more and more tokens have been offered on that platform, you may have heard. If you haven't, it's a really interesting thing to go and look at. Right. There is a token called CryptoKitties. Not making this up. Where literally you have like a digital kitty cat, like on this platform. It was so popular, and there was so much volume, like into this single token issuance, like on the Ethereum platform, that it literally slowed the entire Ethereum network, right? So again, it's quite obvious that the technology is still being perfected, right? That from a public standpoint and looking at true scalability, maybe over 17 trading partners, it all works today. But at scale, at mass scale, like the technology still needs a lot of work. The underlying fundamental infrastructure still has to be improved.
So we're going to go to some questions now, but I just want to make sure we can at least focus on a couple takeaways today, and that is, when you go back to the boardroom, before you raise your hand and you're the one that brings blockchain to the agenda, think about it. Think about whether this technology is core to what your business does, necessary to what your business does. And if it is, then you're going to, and there are opportunities when it's done right. It can create trusted networks among banks. We are going to see this technology assist in providing liquidity for esoteric trades of securities. It's not that it's all bad, but please don't leave today thinking that it's anything other than what it is. It's going to introduce risk into your portfolio of already existing risk. And if your board is good at managing the risk that they already have, and I'm sure it is, what's a little more risk? Bring it on. Some 17-year-old in, what country are they likely to be in? Moldavia. Nothing against Moldavia. Will be up at night studying your network.
You won't know because they've spoofed their geolocation.
Trying to figure out where the weaknesses are in your blockchain. There's a lot of liability out there, and we don't want you to leave today thinking anything else. So let's go to a couple questions, and we invite you to add any others that you'd like. The first question that we're going to ask, and this is a Bitcoin question, but anonymity and being able to do transactions in secret has always been something associated with Bitcoin. Bitcoin was initially used to buy bad things. We all remember Silk Road. To what extent is Bitcoin a cover for bad people doing illicit things on computers that they shouldn't be doing? And to what extent does it provide anonymity?
Yeah, look, to some extent it is a cover. It is not anonymous. I mean, I think so. That is something that is mistaken. I mean, remember, there is a public ledger. Every transaction can be seen. You can't necessarily tie a transaction to an individual, right? So it's pseudonymous, so to speak, like where you can see a portion of the data, but not all of the data. There's no question Bitcoin has been used for nefarious things. There are ways to quote unquote wash Bitcoin in a manner that makes it hard to track, but with enough computing power, it is all trackable and traceable. You may not, again, be able to tie the token to a single individual, though. The single most utilized store of value in the world for money laundering is the US $100 bill, right? It's that simple. Like in this instance, at least, like there's a digital record as to how the transactions are occurring that is audible and is traceable with enough computing power, right? The Federal Reserve, and I don't know if there's any regulators from the Fed in the room today or anything like that, but look, the Federal Reserve came out with a study 2 or 3 years ago. They don't even know where half the $100 bills they've produced are, like at this moment, right? Clearly, like the top device for money laundering in the world today, US $100 bill.
Frank, question, blockchain replaces intermediaries with miners. Someone's making money to facilitate transactions. I think we would point out that not all blockchains are miner-based, and in fact, that's something relatively unique to Bitcoin.
It's
Ethereum.
relatively unique to public chains, I think, where you need to build trust. One of the ways that's done Bitcoin blockchain is miners doing work, which is solving, encryption algorithms that essentially unlock those tokens of value. How all the tokens effectively that are
So mining is not an aspect of all blockchains by
no,
any means.
private and semi-private blockchains wouldn't typically have a
And the way that would work is
aspect.
instead of allocating the confirmation process to miners, you would assign individuals with authority.
What you have in the private and semi-private blockchains rather than the Bitcoin blockchain. Remember, Bitcoin blockchain, one of the elements is establishing trust where none exists across groups who don't know each other. When you and your 17 trading partners are utilizing blockchain to, as I said, register counterparty risk or derivatives trades or syndications, you know your 17 partners, right? You know who they are. You've underwritten each other, right? All the things that we talked about in the beginning, the due diligence aspects, the governance aspects of who you're doing business with, why and how, presumably have already occurred. It's still a requirement, right? Blockchain in that specific implementation may be lowering cost. It may be increasing visibility to how risk and counterparty risk is being traded across your partners, right? But what it's not doing is building trust because you already trust your counterparty who's on the infrastructure and platform
Frank, the
with you.
question is that China can subvert an entire blockchain, and who wants that risk? Well, first of all, I think we can all agree the answer would be no one. But I think we should point out that the Chinese control of the network that I actually referenced earlier was the Bitcoin network, where they have tremendous amount of control and could subvert that network. That doesn't necessarily mean that China it can exert its influence over blockchain technology in general.
That's correct. They might. It's and I'd say more theory than application. It might be possible in the Bitcoin blockchain where they control like in the country, the majority of the mining power, more as Ken said, more than 51% of the mining power is actually coming from China today. And mining is important to establishing trust on the network of every transaction and block that's written in our chronological ledger. Like that is an important aspect, but that's not true of other blockchains. It is very specific to the Bitcoin blockchain.
This is a great question. It's something that I wanted to mention earlier. Whoever solves quantum computing will crack every blockchain. Absent a central authority, this will be a catastrophe. What I was going to say earlier, Frank, is that, and I think this is a very important takeaway for today, to remember, anything made by human beings can be unmade by human beings, as a rule. I'm not so sure if that's a law of physics. I don't know where that falls in, but I'm going to tell you it works.
Yeah,
anything made by human beings, anything created, can be cracked by human beings, and has been.
Solving encryption's about computing power and time, right? And if you have enough of both, you can actually unencrypt anything. Right now, the question is, do we have enough computing power today pooled up in a manner that could actually unencrypt? The answer is no, but that's today.
Changing every day.
Right.
Exponentially.
Right.
To give you some perspective on how technology changes, and Frank had mentioned that he and I had started mining early on to learn more about Bitcoin at any rate. The way you mine Bitcoin, it's with a computer, and it has chips on it. Same kind of chips that you would find on a circuit board, on a CPU, on a laptop. And those chips were big, and when you put electricity through them, they would solve equations, and they would put out a lot of heat. And there were big fans on them. They would put out a lot of noise. And all of a sudden, another company in Sweden figured out how to make that chip smaller. More chips in the same space. And then another company did the same. The first time I ever heard the word blockchain, I was in Israel, in the Negev desert, at a company that had made the smallest chip yet. They could get 100 chips in this much space to come up with a Bitcoin solution. So the technology involved is dealing with heat and plugging something into the wall and spending money on electricity. to come up with these solutions. That's one way to service a public network. But just don't think of all blockchain technology the same way, because it can be very, very, very different and much more sophisticated. But in terms of Bitcoin, that's trading now at how much? And I'll make my prediction on the price. It's not a prediction. I'll tell you exactly what the price is going to be a week from today, when we're done, based on my. But that's how it's done today. It's rudimentary. It's prehistoric. It's noisy and loud, and it's work, carrying around big servers, and it looks like it's a mess. These places. If you look at any of the pictures of the Chinese and the way they do it, you can imagine acres and acres of these computers just sucking in electricity. It doesn't quite sound right, but that's the way it goes. How come banks haven't embraced Bitcoin?
Well, banks are highly regulated
they?
entities. No, I don't think they have, and I think that's been appropriate given the nature, that synonymous nature of Bitcoin that we described earlier. Look, banks are heavily regulated entities to some degree. As a banker myself, like in my opinion, where the regulations are really structured in a way that that banks have to police their customers, like in a way to register financial crimes with regulatory authorities, things like that, have proper oversight of transactional volume, understand whether transactions are within a norm of a company or an individual's like transaction history, point out and flag when they're not. The synonymous nature of Bitcoin and turning that back into cash in a bank account is a relatively risky venture, right? For a bank, you can't tell what the source of funds is, like in any circumstance, because you just don't know. Like, you don't have the same controls of registry of funds flow. There are some banks that are supporting Bitcoin. There are certainly banks that are supporting other forms of either cryptocurrency and blockchain, and I think that those are the more interesting things.
In fact, J.P. Morgan will come out with their own one day.
Well, there are, just to case in point, I know there's a San Francisco-based blockchain infrastructure company, like in dialogue with 2 Asian central banks right now, right, about issuing their currency in a digital form.
Frank,
right? That will happen.
You and I have both been CEOs of publicly traded entities, and we've both spent great periods of time with our friends in the accounting field, our public accountants. How does blockchain impact our friends in the accounting industry? What can corporate boards expect to see in terms of cost and timeline in their audit and their certifications once blockchain's been introduced?
Yeah,
it's
a great question. I think intuitively you might think that it actually decreases the audit aspect. It maybe someday in the future, when implemented, scaled, and well reviewed, that's the case. But initially, highly likely, the audit aspect significantly increases, like auditor oversight and cost and things like that. Going back to governance that we were talking about earlier. Look, when you're implementing this and you're thinking through all the things, look, putting partners on a platform, understanding whether the data flowing into the blockchain is good, still requires the same type of due diligence and audit aspects of any contractual.
And I want to stop you right there, because I think if there's another point, for me, this would be the most important point to bring back to the corporate boardroom. And it goes back to what I said earlier, garbage in, garbage out. The fact that you're going to establish a blockchain at your company for valid reasons or otherwise, maybe just out of curiosity, because it's the next shiny thing. I hope not. But the fact that you do it, and when you do it, doesn't mean that there's any more integrity, reliability, or trust in that material than had you used an Oracle database, Linux, or a ledger with a pencil. It just doesn't. The reason is because there's still a human role. Data has to come in to the blockchain. It's true once it's on a blockchain. It'll be very hard to hack. It'll be very hard to interrogate from anyone that doesn't have a permission. It'll be transparent. It'll be all of the great things that blockchain provides, but it has to get there first. So if somebody makes a mistake in your organization, or worse, it's not a mistake, it's intent. You know, as a banker, any banker that says that they've never been hit by a credit loss as a result of a borrower having control of someone on the inside who they paid off illegally is lying, because it happens to all of us. We're embarrassed about it. It's a crime, and we hope that people don't get away, and they generally don't. But you'd be amazed how long they can go. Bad things can happen, and in preparing that data for your blockchain, bad stuff can happen. And once it's in your blockchain and it's going to be protected, think about it. You are protecting bad information, perpetuating it on and on and on. And the ramifications can be catastrophic. We haven't seen it yet because we really haven't seen blockchain to scale. And I know that there would be people from perhaps, I don't know, I'll single out IBM, or who may differ with me. They're thinking about smaller private blockchains where they've got more control. The reality is bad data exists in my world. I don't know about yours, but in my lifetime, in my career as a corporate executive, it's certainly nothing we're proud of. We fight hard every single day to sustain the integrity of our data wherever it is. But there's bad data in the world. And there's going to be bad data in your blockchain. And you need to think about that when someone is in your boardroom selling you the coolest, neatest new blockchain package, telling you how you're going to be able to trust it, rely on it, and how great it is. Only as good as the data that goes in.
Yeah, I do think it's important to note all the aspects of governance still apply, right? Business continuity. For example, just because you're lighting up this new service or product or whatever it may be on blockchain doesn't mean you don't have to think through the normal things you would building a new platform, product, or infrastructure.
Redundancy.
Yeah, which may be easier given the distributed nature, or may be more complex given the distributed nature, right? Your reliance on others.
So when somebody comes to you and says, the sheriff's done a good job here for the last 200 years, but he's expensive. I don't think we need the sheriff anymore. The town's gotten along just great. We're all friends now. Let's let the sheriff retire. I'd be very careful before letting the sheriff retire. And that's really, in a sense, what you can be facing today as this new technology comes into being and begins to scale.
Yeah, let's face it, removing intermediaries who provide real value from a governance and oversight standpoint, and by the way, have balance sheets and D&O policies, isn't necessarily the best strategy for implementing.
Right. Who do you sue when something goes wrong? And there are no more intermediaries left. I hate to say that. Yes, I'm a non-practicing, I suffer from being a non-practicing lawyer. But the reality is allocation of risk and liability is a real thing in the corporate world. And if we're going to get rid of all of our intermediaries and all of their balance sheets and all of their assuredness on our transactions, who do we look to? Each other at the boardroom? So again, there's some unexpected ramifications that go along with implementation. So if your Oracle database is working and your bills are going out and it ain't broke, maybe you don't fix it quite yet.
Well, trust, distributed nature, liquidity to illiquid markets, there are reasons to utilize blockchain, right? But not every application belongs on blockchain.
I like to give one tangible example that's close to my heart. I don't know if there are any other bankers in the room. But to illustrate kind of how blockchain would work in my industry, if a company came in that was selling us, if we were all on the board together at the bank, a product, they'd say, you know what, we don't need Ken anymore. How much does Ken make a year? We can get rid of him. Because all he does is take deposits and make loans. And that, by the way, is all I do as a banker. That's basically what we do. In a regulated environment with the benefit of deposit insurance. We take deposits and we make loans. What are we needed for? What do I do? Here's what I do. I validate for the depositor. We all know that we take the depositor's funds and we lend it. That's the money we're lending. We pay the depositor 4%, we lend it at 6%. That's the banking business. And I get paid to do that in the middle. Blockchain technology can get rid of me. You don't need me. I'm gone. I slow things down. I do, I guarantee it. My credit underwriting will slow you down. And I cost money. So get rid of me. So what do we have? Depositors making loans directly to borrowers. And how do they do that? Because they're on a blockchain, a private blockchain, they're qualified, and they're allowed to trust each other. When the borrower says, I have $2.3 million of liquidity, and I am actually really going to pay you back, you're allowed to trust that statement. And when the depositor says, I've got $1 million here ready to lend, and I can produce it tomorrow at 2 o'clock, you really can. You don't need me anymore if that world really worked.
Yeah, and by the way, the concept Ken is describing here is actually not concept, right? There have been at least 3 initial coin offerings for peer-to-peer lenders to do exactly what he's just described on the Ethereum platform. So as experienced bankers, I certainly believe highly likely not to work, tripping afoul of more regulations than I could possibly rattle off here. But people have actually issued tokens and raised a lot of money, right, through their initial coin offerings to attempt to do some of these things that Ken's describing here right now.
They've been saying bankers are dinosaurs for a long time now. Gates said it in 96. He was wrong. Banks are still around.
He also said 256K would be enough.
That's right.
Enough memory
That's
for
right.
anyone.
And you know why we're still around? The same reason other intermediaries are still around. Because we're worth it. And if you don't think your intermediaries are worth it, try it. See what happens. It's only the enterprise value that you're putting at risk. So seriously, I'm not that negative on technology. In fact, I ran one of the country's leading internet banks, one of the ones that survived, by the way. We didn't fail. I love technology, but we've all seen that the promise of technology can get way ahead of itself. And as board members today, if we were on Ross Johnson's board, God bless him, maybe it'd be a different story. We'd let Ross worry about it. That was always the right answer, I was told. But we're not. We're on our boards. And we owe our shareholders and our fellow board members and our CEO a different duty than Mr. Johnson's board. And we owe the duty of having situational awareness. And we don't have to be experts in any particular field, but we don't promise that. We don't have to be. But we owe a different kind of duty, and that's the situational awareness to generally know what we're dealing with. So should you know about blockchain? Should it be on the agenda? Should the CEO be talking about it? Yeah, they should. Is it something that's going to revolutionize, disrupt, and change our futures forever? You make that decision yourself. But I suggest to you that we should walk before we run for many reasons, and don't fire the bankers.
Last point's the most important.
How about any questions from the audience, not written, just anything that's on your mind, anything that you'd like to talk about or that we haven't?
Any of these Bitcoins, Ethereum, whatever, become actual currency when the volatility of the currency is so great, the product you're buying, unless you can instantaneously hedge it buying a car. The amount of time it takes, just things of that. If you're supposed to do this because it's faster, quicker, easier, it doesn't sound like it is until we make some major improvement in technology.
It's unlikely to happen. I think it's both the technology and, as you said, it's the volatility of value, right? Are the two primary blockers to a digital token becoming like a modicum of currency and utilized for point of sale transactions. Both of those things are solvable, though. The technology will improve. Just think about it. Once upon a time, today, you swipe your Visa or MasterCard at point of sale, and in 2 or 3 seconds, right, the transaction's authorized. The network didn't always work like that, right? So that's improved over many, many years, and with many technological innovations to get where we are today, where you can have that type.
The other thing I would add, Frank, to that is that there is, at least now, a market, a liquidity market for selling Bitcoin and converting it into dollars.
There is.
Almost instantaneously.
There is, but volatility is the other aspect, right? But as you have central banks embrace the technology as it improves, you may see more central banks actually issue fiat currency in digital token form. As that occurs, like when those two things come together, either stabilization of some token or fiat currency issued on technology without the latency that exists today, you do get to a point where it can be used for real point-of-sale transactions. Not there today, but it isn't impossible that we could get there in the future.
So, okay, so you're using a lot of terminology that I think is going right over the heads of some of us. For example, you talk about tokenization, and I wanted to see if you could make a distinction between tokenization and a private blockchain. If you could give an example like a supply chain blockchain versus a tokenization of a Warhol painting. I think it's a little confusing. You're going very fast.
So like Linux and like other fundamental software packages and like other digital assets like sophisticated databases that Oracle puts out, et cetera. And I heard someone say this earlier today. Blockchain itself is an envelope in which we can put things in. It's a fundamental, not a disruptive technology. It's a starting place. You can get it in a box. What you do with it is totally up to you. So some of the things you mentioned, private versus public versus tokenization. There's so many variables. For us to cover them all would be almost impossible. But a tokenized blockchain versus untokenized is a pretty primary distinction. So
so let's go back to the Warhol painting and try to break that down a little more. I'm sure you're all familiar with securitizations, right? So effectively what occurred here was securitization of 35% of the Warhol painting using a digital token, right, as the moniker of ownership. I'll give you another
token meaning proof of ownership, proof of your participation.
Proof of your
digital. It's not actually a token. We should point out.
Yeah, it's a digital.
And I will point out that I recently gave a presentation to an undesignated circuit of appeal judges. And the first question that the judges collectively, there are over 25 of them in the room, asked me, and they're all very eager. They raised, can we see a Bitcoin? Show me a Bitcoin. And boy, I knew how that day was going to go. So I went, here you go. There are no Bitcoins. Those are our appeal circuit judges. But at any rate, token, just because we use the word tokenization, doesn't mean that you're actually getting a token. It's proof of your participation in a digital transaction. Is that fair enough?
Yes, it is. So you've all likely put some type of digital certificate on your phone or on a computer, so you get access to your corporate network. So you're whitelisted into and onto your corporate network. This is a digital certificate much like that, token.
Proves that you were there.
Proves that you were there.
You own your piece.
And most importantly, it can trade on a market.
Exactly.
It can trade on an exchange.
It's transferable.
So not only could you buy a portion of the Warhol painting by buying a token that represents part of the securitization value, like that 35%, but you can also sell it on an exchange to another accredited investor, also registered on that platform. So again, another example of this, the St. Regis Resort in Aspen, right, is actually just an interesting method of doing this. They actually created a REIT that owns, I believe, 35-40% St. Regis Aspen, and they are tokenizing that. They are going to literally securitize in REIT form what you'll be buying if you buy a token. If you buy an Aspen token, you literally own non-voting common shares in a REIT they established that owns 35-40% of this resort, the St. Regis Resort in Aspen. And that is launching very shortly. It's being marketed now. Obviously, you have to be an accredited investor. It meets the framework of SEC guidance related to private placement memorandum. As it's being structured, effectively you're investing by token in a privately held REIT.
So many of these uses are not necessarily things we would expect to see in a corporate boardroom.
Not today.
Not today.
Yeah.
So while there are uses in that corporate enterprise for board members to look for, some of these uses these practical applications, it's unlikely that the board is going to want to buy 12% of a Warhol to put in the boardroom.
But if you're on the board of a small nonprofit art gallery and you have 87 paintings hanging around valued at untold millions of dollars, and your operating budget for 2019, 2020 is stretched, right? There's a framework, like through a company and an exchange in the UK today, that would allow you to sell, hypothetically, 10, 20, 30 non-controlling interest in some of that art to investors interested in holding it because of the returns in this exotic asset class to fund your operation. There are real practical applications even today, like for some of the things that are emerging here. And I'm not saying like galleries and museums and things like that are going to rush to utilize this technology tomorrow, but look, this is the longest bull market in history. Someday we will actually have another recession. Nonprofit
Frank,
budgets
now that we're on
will
art,
be stretched.
I want to stay on art for one moment. Let me ask you a question. What do you think, and this is just an historical tidbit, having been in about 50 failed SNLs on the weekends, we used to take them over from Fridays to, what was the one consistent thing we found in the CEO's office that led us to know that that bank was insolvent? What did everyone have? That's right. They had an Andy Warhol. And the FDIC became one of the largest art galleries in the world.
I was lucky, and that was in my first job. The gentleman I worked for, Ambassador Walter Annenberg, actually had a Van Gogh sunflowers.
Right, exactly. So. Yeah, was worth more than the bank had in capital. Let me ask this question: exactly. The airline industry has its own settlement process network, and in essence has been doing blockchain type technology for decades. Correct? So settlement among trading partners works, and so here's an example of a process in the airline industry that doesn't necessarily make it blockchain-like. Whether I'm not sure what database they'll use, or whether it's an Oracle-based system, or whether it's Microsoft-based, or whatever. But this points out that yes, in fact, I don't know who asked this question, but yes, in fact, lots of stuff works today. Lots of networks work. They're reliable. The information is relatively accurate. We can transact business with an expectation on both buyer and seller's end that it's going to actually happen. It works. If it ain't broke, don't fix it. So blockchain technology coming in, what missing, gaping, what is it curing? What is it fixing? What is it here for, to solve for us? In reality, it's here to make things better when it's used properly, more efficient. But in terms of fixing any gaping problem, you're right, the airline industry knows how to settle itself just fine without blockchain, and has for a long time.
It's true. Not every scenario with trading partners is conducive to blockchain. That's absolutely
Frank,
right.
how about in terms of energy applications? Does blockchain have specific uses in the energy industry?
Yeah, I would say I think one of the more interesting ones in my mind, fully representing, this is not my field of expertise, but certainly like trading carbon credits is certainly something that resonates, and that is that energy companies have a need, like having marketplaces of tokenized, auditable carbon credits that are trading and, as I said, auditable and validatable across blockchain is actually relatively sensible to me. So I do think there are other applications outside of that, but I think that one is very similar to what we've been talking about tokenizing, securitizing other assets.
So one of the common themes we keep talking about is creating liquidity in esoteric markets that normally wouldn't trade. I wanted to bring up as an example, sometimes reality is stranger than fiction. So there was a person, an individual, a guy in Silicon Valley who applied a blockchain technology and tokenized himself. He took the hours in the day that he was alive and sold them to people who could trade them. I don't even want to know any more about this than that.
But as we're talking about, this is not actually a new concept, right? Right? There have been other companies that have tried to sell off 10% of the recent Stanford grads' future earnings, right? For paying off their student loans today.
That's right.
Right.
David Bowie sold all of his future earnings before he passed away.
If David Bowie was to do Bowie bonds today, there's no question in my mind
he would use blockchain.
He would securitize his royalty rights on blockchain.
But he
right,
was able to sell his future earnings without blockchain, just fine. Of course, it took a big indenture and a lot of lawyers, but it worked. Everyone got paid. Imagine that. You didn't even need blockchain. I just wanted to, we're going to finish up in a moment, and I don't want to finish up before, is there a question?
Yes,
Please,
I was going
thank
to
you.
follow up on some of this stuff you've been saying. I'll start by saying I've been a chief information officer for 35 years. And by the way, I worked for one of those S&Ls in Dallas. And we did have, our art was worth more than our mainframe.
So you agree with me?
I totally agree.
Is that funny?
But the question I love technology, but the question we as board members have to keep asking is what are the costs and what are the risks and how does any new technology change both sides of that equation? So to your point, we've been collateralizing illiquid assets for decades. Obviously, what took the S&Ls down, right? CMOs. But we've been doing that without the need for any new and esoteric technology. If you've got a decentralized zero trust network, if I'm trading commodities through failed nation states where I don't trust the government, then there's a reason for this kind of decentralized zero trust. But if I'm building a network where we all trust somebody in the middle, call it Visa, call it Covicent, call it the Depository Trust Corporation, why do I have to layer blockchain on top of what I've already got? And so we keep coming back to that. If we're going to build a private blockchain for our 17 trading partners, they all trust us and we trust them to an extent. So why are we adding the extra cost and complexity, which doesn't seem to add value, but it adds all the costs
Because
that
it's
you
cool?
mentioned? Because we can raise the stock
Not a good
price
reason?
with Bitcoin washing.
There are certain markets where I think look, generally I think your statement is absolutely right. Those networks work completely fine today, settle transactions quickly, appropriately, efficiently, cost effectively. There are scenarios, for example, NASDAQ utilizing blockchain to register derivatives trades, right? And the trading and sharing of risk, right? Real platform, real scenario built on blockchain-focused company called Chain's Technology, right? So that's a very specific use case where there hasn't been transparency. Trading partners haven't been able to tell how derivative exposure has been laid off to other partners, and that can be solved and is being solved in a blockchain. Not every aspect, not everything we do today is moving to blockchain, but there are some solutions blockchain can provide. And there are certainly companies working on identity held in blockchain that trusted partners could access. So imagine if the next time you're going through airport security. Instead, you've got a digital token on your phone that validates who you are. Or the next time you're entering the Empire State Building in New York City to go see the FDIC on the 30-something floor.
Well, if you had to go to the Empire State Building and see the FDIC.
Yeah, you're
hope
validating
you
with your digital
it wouldn't
token
be good
like who
news.
you are and that you're on the access list. Look, you're absolutely right. That really gets back to, look, blockchain is the foundational component here.
Blockchain is not Bitcoin.
It's not the solution.
Thank you very much,
Okay.
everyone.